Thank you for joining our quarterly webinar. We want to especially thank those who submitted questions, which we will address today. I'm again joined by Andy and Adam, but before I pass the baton to them, I want to provide a COVID update. According to the CDC, actual U.S. COVID infections are about 10 times confirmed infections. So we are now somewhere around 650,000 infected, which is roughly 2% of the U.S. population. Except in New York City, roughly 5% of the U.S. population has had COVID, recovered, and now has antibodies that are believed protective to some degree. In combination, this means we remain highly vulnerable to COVID, and per the VIX term structure chart, which we see on the screen, a second COVID wave and bout of market volatility is expected this fall. But there are three important pieces of good news to support optimism ahead. First, masks have proven much more effective than initially expected, and masks are becoming less politicized. All major vaccine trials have experienced no setbacks, and we remain on pace for widespread COVID vaccinations later this year. And Harvard epidemiologist Dr. Michael Mina has a solution to contain COVID that's ready to execute almost immediately. We'll share a link to this podcast later today, but here's the executive summary. Because COVID virus loads are so high during the early stages of infection, much less expensive and sensitive tests can be used to ID early infections. Several companies have already developed these quick, saliva-based at-home tests that would cost $1 to $5 per test. Taken daily, Dr. Mina expects COVID infection rates could be driven towards zero virtually overnight. The strategy has gained traction on social media and is getting some political attention now as well. Hopefully we'll hear more about this soon. Dr. Mina in his podcast also explains how pooled testing works and how effective it could be for things like reopening schools. COVID pandemic control is obviously baked into recovered stock prices, but price momentum continues to favor companies less impacted by the associated economic disruption of COVID. The chart that we have on the screen are monthly return differences between value and growth stocks. At the far right, you can see the strong pro-growth market move that has coincided with the COVID crisis. However, fundamentals heavily support their value opposites, as is evidenced from this chart. In this chart, what we're looking at in the blue line are rolling 12-month value versus growth return differentials. When we're below the origin, it means that growth stocks are outperforming, which is strongly the case of late. The gold line above it is the relative pricing of value versus growth stocks. And what we're seeing here is a lot of growth momentum, but with growth stocks being priced relative to value around an all-time peak sort of value. So the fundamentals are important to consider. But the two things that most investors will look at when they're making an equity selection decision will be momentum that favors growth, but also fundamentals which favor value. Ultimately, these fundamentals win out, and we will, in time, certainly see a rotation that'll be back towards value. Some are comparing conditions today because of this significant valuation differential and this strong growth run, and they're comparing conditions today to the dot-com era, which we believe is inaccurate. By the late 90s, value stocks were extremely cheap, much as they are today, but growth stocks then were also extremely expensive. Growth stocks are not fundamentally grossly overpriced today, so the market's eventual rotation to value will not coincide with a growth bloodbath as occurred then. I'll now turn the presentation over to Adam.
Thanks, Lowell. And I'm going to spend a little bit of time talking more broadly about the broad asset classes within the market, both for the quarter and also looking back the past 10 years or so. I'll touch on just the general economic conditions that we've been seeing as we've come out of a really poor Q1 and into a little bit of a stronger Q2. And then based on a very, very large number of questions that we fielded in anticipation of the webinar, I'm going to put some data behind stock returns in election cycles. So everyone now, as we've moved past the initial shock of the virus and the spread of the virus, a lot of focus now is being placed towards what's going to be happening this fall. So I'll try and put some context from a market perspective only, behind what that might mean. So as we know by now, we had a really strong second quarter rebound in equities. The S&P, as we stated in our quarterly letter, had its best 3-month performance since 1998. And the Dow, if you're looking at that as an index, that jumped the most in a quarter since it had since 87. So historic performance of stocks coming out of a very volatile first quarter. And if you look at it at the sector level, within the stock returns, you had things like consumer discretionary, technology, and energy leading most of this rally from the bottom. Those 3 sectors had total returns in excess of 30%. And then some of the more defensive assets, things like utilities, consumer staples, they had smaller gains. They recovered, but the gains were less magnified. Andy's going to touch on this specifically when he talks about, what are the types of companies and characteristics of companies that tend to lead us out of recoveries, and how is that different than the type of companies that we're evaluating and investing in during a more normal market cycle. If we look at the fixed income end of things and what's happened in the bond market, it was a pretty flat, low single digit, a very average quarter for bonds. Interest rates essentially started and ended the quarter at about the same level. So not too much move in yields. Again, a big contrast to what we saw in Q1, where yields went down significantly. And when I say this, I'm really referencing some of the higher quality bonds, investment grade bonds, treasuries, high quality corporates. We did see some of the higher yielding bonds, bonds of riskier, less financially stable companies tended to rebound a little bit sharper because they tend to move a little bit like stocks when we hit these more uncertain periods of time. So a big driver of this certainly was some of the developments in terms of the economic recovery, which I'll talk about, and then some of it was actions that were taken by the Fed and our government. This is a longer-term view of the same general investment categories going back 1, 5, and 10 years. It gives us a good picture of what the trend has been across these categories, and it's been a common theme and something that we've been touching on. It feels like on a quarterly basis. There's 3 return gaps that have been persistent with a fair amount of momentum behind them. The first being the return differential over the last 10 years between domestic and international equities. The second being the return differential between large and small cap companies, which isn't necessarily indicated here, but it's very prevalent. And the last, of which Andy will review, is the return gap between value versus growth. So you can see the persistence, you can see the steady, gains, even looking back at 5 and 10-year windows of the U.S. markets compared to some of the alternatives, and the relative consistency of bonds. Since the bottom of the financial crisis, a lot of conversation has been driven up by what's going to happen to interest rates. Rates are going to be rising. Should I have exposure to bonds? What does that mean for my bond portfolio? But bonds have been incredibly resilient. We've seen rates flatline and actually continue their trend downward from already low levels. Another question, I talked about the election question, which was a common one amongst our clients. Another big question we got in anticipation of the webinar was, what changes should we be making as it relates to what's happening right now in the environment around us? Should we be taking risk off the table? Should we be considering other types of investments? I think now with a relative calm back into the markets based on what we were experiencing a couple months ago, it's a good time to have that conversation on an individual basis with your advisor. So because everyone's in different tax situations, their risk preferences are different, they have different needs from their portfolio, both short and long term, that's a question that's best going to be served one-on-one. We're not of the thought that we should be making blanket moves across asset classes, based on, what we think should be happening at any point in time. The equity piece will be active, and Andy will talk about what we're doing there and what's important to look at. But in terms of asset allocation and big adjustments in your risk profile, we really encourage you, to leverage our team and leverage your advisor and point of contact to revisit that conversation now, again, while we have a sense of calm back in the markets. On the economic side, the sharp recovery we saw in stocks was really reflected of, an abundance of liquidity and hopeful expectations about the reopening of the economy after the global shutdown. And the Federal Reserve really delivered on this front with massive monetary accommodation. That they're making asset purchases and things like treasuries, mortgage-backed securities, municipal corporate bonds through some new facilities they developed. So about $7 trillion is the size of their balance sheet as of the end of the quarter. So what was started back in the great financial crisis, and had been continued for some time, really came back to the table and was accelerated. And this just isn't a domestic theme. Europe and Japan started up their QE programs as well. So global central banks were really injecting more than twice the liquidity of what their previous easing periods looked like. And I think it's important to acknowledge the long-term implications of this, which the straight answer is we're still in the process, everyone is, of trying to quantify what that might mean. There's arguments in different directions on the pros and cons of this in the short term, but the reality is what took months and months to put in place during the great financial crisis, both at the government and the fiscal level, what took a long time with a lot of heated debate behind it, got put in place very quickly this time around. So we went back to a very similar playbook, we expanded it, and we acted on it right away. And that really helped, I think, calm a lot of the market concerns and got us back up and running in quick fashion. And what we also saw during the quarter was markets reacting sharply up and down to progress in developing treatments and a vaccine for the virus. And I think a good example is, April 17th was the day that jumped out. We had a very high pop in stock prices after there were some unofficial reports that came out that Gilead has their drug that's in the trial period, remdesivir. Was posting positive developments, which were later retracted, and you saw stocks move the other direction on it. So that's a one of many examples we're starting to develop on movements up and down based on developments as it relates to the virus and its treatments. But Dr. Fauci, as we all know now, is the nation's, he's our top infectious disease official. He's later reported to a congressional committee that, a vaccine's a matter of when and not if. So he's optimistic. I think the medical community is increasingly optimistic that we're going to get to something by the end of the year. But on a day-to-day basis, and as we're trying to play this theme, markets are going to act fairly speculatively to this all, transpiring. And if we look at the data, outside of the virus and what the Fed and the government's doing, we did see an improvement of economic data in the quarter, and that did certainly help to offset some of the fears in the short term. I think the signal event happened in May with the jobs report. It was released out in early June, and it showed employers bringing back about 2.5 million jobs in May, which was a complete deviation from the consensus expectation for a decline of around 8 million jobs. So a historical gap in what was reported versus what was expected. So instead of rising nearly 20% as what was being forecast, the unemployment rate fell down from 13% to almost 15%. So that was a positive in the labor market. Retail sales bounced back in May, and there were several other indicators showing a recovery in manufacturing. So some of the data is going to be volatile. We understand on a month-to-month basis. It always is volatile month-to-month, but the trend in data, if that continues to maintain more of a positive posture, that should help calm things down. But until we really hit the, the treatment, the vaccine, and until we start to see these case numbers come down, the story is going to continue to be COVID's trajectory and the policy support that comes behind it. So, we've got corporations pulling their guidance. We've got uncertain and changing data. So that's the theme, and that's why Lowell, as you looked at the VIX, which is representative of market volatility spiking towards the fall, we see that as the next wave as we head to, Q4, just the uncertainty level and how we anticipate markets might react to that. And so moving on to the election end of things, before I pass things to Andy, this is, every election cycle, this is about the time we start fielding numerous questions about a particular election and its market impact. So I'm going to spend a little bit of time here. And I'm going to start by saying this. As investors, no matter what the theme is, it's in our nature to try and simplify things. It can be especially fun in our minds to draw up, conclusions like here's going to win, here's who or what party is going to win office, and this is how the market's going to react as a result. Each election has its own set of ups and downs and big question mark events attached to them. But it's in our nature to try and extrapolate an election outcome and translate that to some sort of market performance. But the reality of it is that the data just doesn't support it. So what we have here, and we went back as far as we possibly could, we're looking at previous administrations and the corresponding market returns while that administration was in office. So go ahead and look at this and tell me if you identify any consistent pattern. And if you're having a hard time while you're doing it, because there really is no predictable path that the markets take based on the individual or the party that's in office. And the reason being is there's too many things that influence stock prices. There's hundreds, if not thousands, of variables that play in the market returns over day-to-day, month-to-month, year-to-year basis. We're giving any president way too much credit if we think that they themselves are going to be able to move the multi-trillion-dollar behemoth, which is the stock market, especially with some of the checks and balances that we have in place in our government in particular. So presidents and prime ministers of other countries, individual companies, pandemics and medical advancements, developments in technology, commodity prices, and a number of other things will all play into the markets. So there's no, and for that reason, there's no one individual or even party that can swing things in their own favor as a result of this. So if we look at the numbers and we look at the average return of the market for each of these periods, regardless of our political affiliation or our beliefs, we want to capture this. We want to capture these attractive average returns over time. High long-term returns means a greater ability to meet our goals and more certainty in our plan. So we want to capture this no matter who's in office. And that means sometimes dealing with the uncertainty that comes with each election. It also means, and especially now when emotions are a little bit high in both directions, it means dealing with political wins and losses of our own preferred party. So it's a very exciting thing to talk about and try and dream up market scenarios, but the data shows that there's absolutely no connection between who's in political office and what the market's going to do, given the number of variables that are at stake. So hopefully that it starts to answer some of the questions people have about the election. We'll build on that as we head into the fall. But now I'm going to pass it off to Andy to give you an update on size and style and what we're doing in our portfolios.
Great, thank you, Adam. Yeah, it's always fascinating to see how global stock markets are doing, and it's always informative to look at some macro trends. But the truth of the matter is, most of those things are things that are outside of our control. But that does not mean that they don't create certain opportunities for us. So I'm going to be transitioning now to a focus on our specific U.S. equity strategies, and in particular, two major opportunities that have developed as a result of all of this market volatility. So the first one relates to our size and style positioning. this has not changed since our last webinar. We remain tilted towards value, in large part because the valuations of value stocks look historically attractive based on historical returns. And small cap stocks too typically lead recoveries coming out of bear markets. So we've shifted our allocation in March towards small caps. Now, if you remember, large cap stocks are fewer in number, but they make up by market cap most of the stock market, somewhere between 75 and 80%. So when we talk about tilting towards small caps, we're moving that large cap allocation down to something more like 65%. That results in about a 10% overweight of small cap companies. Now that we've had some time to see how the market has played out over the last few months, and I always do that, I apologize. So it's a fair question to ask how our positioning has done. So far, I think it's fair to look back at the bottom of the market, which was March 23rd. And we can see over this time frame that large caps and small caps have basically been highly correlated with each other. Small caps hold a slight edge over large caps, and there was particular momentum in late May all the way up through June 8th. But the market took a bit of a breather then, and we saw some of that momentum dissipate. But I think at the end of the day, this is whether you're invested in large caps or small caps, you've seen strong returns from the market bottom. Value for most of this time frame actually followed a similar path to the difference between size. So value actually held the edge over growth stocks all the way through June 8th. And then once again, the market took a bit of a breather and that value momentum stopped. And in fact, the entire gap since the market bottom between growth stocks and value stocks has really come over the past few months. But this is something that we've seen happen throughout the recovery, where value and growth go back and forth in terms of momentum, and I'd expect that to continue moving forward. But it is a fair question to ask, are we still confident in our value tilt? I think you might know, from Lowell's slides that we are, and it's in large part due to valuations of value. But one of the things I like doing is look at other firms and people in finance to see if what they're seeing corroborates what we're seeing in our research. I showed this slide in our last quarter. This is from O'Shaughnessy Asset Management. And they show that the valuation spread between small value and large growth stocks is only as wide as it is right now, about 1.5% of the time historically. And in the past, when small value is this cheap, small value delivers double-digit returns annually over large growth over the next decade. Right now, it's easy to invest in the FANG stocks and a lot of the mega cap stocks that have been dominating the stock market. But keep in mind, what often wins in one decade does not win in the next. There's a good chance that we'll be wondering what happened to this FANG dominance when we move up to 2030. Here's another slide that we showed last quarter. And I think it's important to remember that we're still barely more than a quarter removed from the market bottom. In fact, tomorrow will be the 4-month anniversary of the market bottom. So we're really still in the early innings of this market recovery, even though the comeback has been so strong. And again, when we look back historically over 1, 3, and 5-year time periods, small value is where you want to be coming out of a bear market. This next slide was not in our last presentation, but I think it's another slide that corroborates what we're seeing. So this is from AQR Asset Management, and what they show is that the valuation spread between value companies and growth companies is basically as wide as it gets going back to the 1960s. And they go a step further in their analysis. This is just one chart, but they show that fundamentally value and growth are no different than they normally are. It's not just the mega cap stocks that are outperforming. It's not just a winner-take-all monopolistic pricing power from some of those companies. And it's not that the ways that we measure value are broken. This is simply a pervasive phenomenon. Simply put, investors are paying way more for stocks they love versus the ones they hate. So to answer the question that I posed from before, this is the evidence that we're looking at when we're talking about our value tilt. And even though we've seen some growth momentum over the past 6 weeks, I think over the long term, when we're looking at 1, 3, 5-year time periods, that value tilt should pay off. The other big opportunity that we're seeing arises out of stock selection. And to understand this, you have to understand our normal stock selection process. Jack Burney is the founder and namesake of our company, and he was a trained engineer at West Point, a brigadier general in the Army, but his passion was always stock selection and stock analysis. What he did is he took an engineer's thought process back in the 1950s to finance. And as a result of that, he was doing some things there back then that we would consider pretty modern by today's standards. Concepts like factor-based investing and smart beta products that have come to prominence in the 2010s are conceptually similar to what Jack was doing back then. And in his process, he didn't just look at different stocks and try to guess their returns based on price momentum. He would go to libraries so he could gain access to financial newspapers, and using little more than a slide rule calculator, he broke down stocks into their individual factor components. So themes like value and profitability. And what he calculated was certain factors are correlated with long-term excess returns. Things like a lower PE ratio predicted higher returns. Things like a higher return on equity predicted higher returns. And earnings growth and sales growth, while important, have to be balanced with price. So when he founded the company in 1974, he brought this framework and the stock selection model with him. And today, conceptually, what we do when we model stocks is very similar to Jack's insights way back then. We've come a long ways in terms of the ways that we calculate things. So we no longer use a slide rule calculator. We have our own analytical systems and algorithms that do all of our calculations. But it's the same thought process. Break a stock down into the individual factor components that are correlated with long-term returns, and then choose stocks that are exposed to those factors. And what we know from this model is it tends to work in normal times, and it's actually especially effective in market downturns. But perhaps the most consistent part of this is that while it is effective in market downturns, it tends to invert when we get market recoveries at the bottom of that volatility. Put another way, when the market is selling off, the group of stocks that the model says to buy outperform the group of stocks the model says to sell. But in the recovery, that pattern inverts, and the group of stocks that our model says to sell outperform the group of stocks it says to buy. And while we knew about this phenomenon, for most of our company's history, we just accepted it as rub of the green. And the reason why is twofold. One, we wanted to be confident in any company that we ever bought, that it could be a long-term holding. We wanted to avoid owning junk companies. And two, at the end of the day, this phenomenon tended to be a wash from a performance standpoint. So, we would just stick with it, and then once the market turned back to a normal period, we would expect our score to become effective again. But in 2015, we challenged that way of thinking. We thought to ourselves, if this phenomenon is so consistent and happens basically every time we have a market sell-off, is there a way we can exploit it? So what we did is in 2015, we decided, what if we took the same framework that we do for our normal stock selection process, and instead of training the algorithm on past normal market timeframes, let's train it on past distressed timeframes, right? So now maybe it'll pick up on the types of factors that work when there's a lot of market volatility. So if this is the way that if this is the way that you can conceptually think about our model framework, this is what our normal model tends to look like. So there's a bigger weight on concepts like value and profitability. These are concepts that tend to work over the long term. But when you train the model on past distress intervals and you model what works coming out of recoveries, the model looks different. So now, concepts like safety are maybe less important, and technical indicators like price momentum are very important in the model. So we ended up with a very different looking model than our normal process, even though, the bones of the model are the same. It's just the time frame we looked at was different. And in our back test, we got great results. So this is an example. In 2011, there was a market correction, and in the recovery coming out of 2011, our normal score model was inverted for about a year and a half. However, during that same time frame, this recovery score that we created remained effective for 2.5 years afterwards, and over the same time interval had material effectiveness. But the problem with back tests is often the worst period for your back test is the next live period. And we were fortunate enough at the end of 2015, beginning of 2016, to get an opportunity to test this model in real time. What we found, once again, the model was effective. Our normal score modeling process was inverted. The sells did better than the buys, but with this recovery model, our buys did better than our sells. Back then, though, we did make one mistake. And that mistake was that we assumed once the stock market got back to its previous all-time high, that the effectiveness of this model would go away. And what we learned is we turned off the model way too early because this model remained effective for about 2 years after the market bottomed. So if we fast forward to today, once again, we have another opportunity to turn on this model. And once again, we've seen that in the recovery, our normal score has been slightly inverted. However, recovery score has been highly effective in sorting the stocks that you want to buy versus the stocks you want to avoid. And the way that we've utilized this model is we took a phased-in approach. And you may have seen over the last quarter more trading than you're typically used to. And a major reason that we were doing so much trading was to incorporate this score into our portfolios. You can expect one more large round of trading this year before we go into tax loss harvesting mode for the fourth quarter. But to give you an idea of what this looks like, here is a chart of one of our typical portfolios at the beginning of the year. So the blue bubbles are the individual holdings in what our typical portfolio would look like as of January 1st, 2020. And the gold bubbles are the individual holdings of a typical portfolio today. Now, as you can see, we've shifted the entire line up so that we're incorporating recovery score into our process. You might notice there still are a few holdings in there that are below the buy threshold by recovery score, and that's a couple things. For one, those are companies that are in defensive sectors, things like utilities, things like consumer staples, where those types of companies do tend to lag in recoveries based on their defensive nature. However, we do insist on staying diversified at all times, so we do hold those companies there. And there are also some tactical choices where there's certain, healthcare companies, for instance, that are creating, COVID vaccines or COVID treatments that we want to remain exposed to, even though the recovery model might suggest that it's the type of company that won't have excess returns in the recovery. So there are a few tactical changes, but by and large, you can see that we've shifted our portfolio up utilizing this score. So I wanted to thank everyone for attending our webinar today. I know there were a lot of questions, and I hope we were able to address most of them. If not, though, and if any new questions did arise, please don't hesitate to reach out to your advisor, who would be more than happy to have a discussion with you. We'll be sending out a recording of this webinar at some point later this week, so please keep an eye out for that, and feel free to send it to friends or family or whoever you think might be interested. Stay safe, and we'll talk to you all later.